This is the Rocket City Retirement Show with Chris Wallace. Chris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Chris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Well, the interest rates are on the move again. You've heard that for sure. The Fed's recent vote to cut those rates happened, and we're going to talk about what that change means for you and for your investments and your retirement savings. So that's what we'll be doing today. Thank you so much for joining us on the Rocket City Retirement Show. I'm Luann Fulmer here with Certified Financial Planner Chris Wallace. He's a financial advisor as well and president at WG Financial Group. So I want to give you the phone number for our show. You will have questions. Surely you will. And you know what? You can get answers. And these are going to be personalized answers when you go in and see Chris and the team at WG Financial Group. Go in for a discovery session because it is complimentary. Now, we've made it easy for you. You can call or text the word visit to 256-937-2010. Again, that is 256-937-2010. Call or text the word visit for that complimentary discovery session. Go in and meet this friendly guy that you hear on the radio station every single weekend. Chris, so excited to be here with you today. Your motto, plan, retire, play. I totally love it. And I want to remind everybody our show is available on Spotify and Apple Podcasts, wherever you get your podcasts. Just search for the name of our show, Rocket City Retirement Show. Chris, excited to get started today.
Excited to be here with you as well, Luann. No Gritch. I said no Gritchard. No Richard.
Gritch, no.
Tried to combine Graham and Richard. No Richard or Graham.
I love it.
Let me have another sip of coffee this morning.
I think we need to call them Gritchard now.
Gritchard. If Graham and Richard had a baby, it would be Gritchard.
Gritchard. Was that a girl? Is that a girl or a boy? It could be a girl. Gritchard.
Well, we're going to say it's, I guess, a boy. Gritchard just sounds more manly.
Okay.
Yeah.
I was thinking of Gretchen, I guess, but yeah. Okay. Gritchard. That's hilarious. So can't wait to tell them that. But all right. So let's get into these interest rates right now. My goodness, you know all about this. You knew they were going to be cut. So tell us everything about it. And then I also have a cut from Jerome Powell that we can play.
Oh, the man's most exciting voice, right?
Uh-huh. Yes. I thought that would liven up our show.
Yes. Oh, Lord. He's so exciting to listen to. Yeah, so we have talked about this. I think we talked about it a week or so ago. But so the Feds did. They came in and they cut, 50 basis points. And we knew that we knew there was going to be a cut. And we just didn't know how aggressive it was going to be up until maybe 2 or 3 weeks before the futures started to really predict a 50 basis point cut. And to be honest, it kind of went back and forth. And, if you followed our Facebook page, WG Financial Group 256, you can actually see where I was posting throughout the last 3 to 4 weeks or so leading up to the cut. I was trying to tell our listeners and people that follow our page kind of what the indication was going to be when it comes to what the Feds were going to do. And they ultimately did 50 basis point cut. So, I would expect, and I've mentioned this before, but I would expect another 50 basis points, but I think it's going to be interesting right now because, as we're recording this show, Israel's having missiles shot at them again. There's a potential strike on the East Coast where some ports could shut down. Mm-hmm. So there's a lot going on that could hit the economy. And I'm not saying this to scare everybody to death, but it'll impact some decisions in the economy. So it will be really interesting to see how things play out over the next few weeks.
Yeah, my son-in-law just texted me today and said that strike has started on those ports. So we got to stock up on our foods and put some things in the freezer, Chris.
Yeah, I don't know if it's going to be that bad. I'm not one of these doomsdayers, but yeah, you may want to. Yeah, I don't know. Maybe treat it like a snowstorm when everybody goes to the
yeah. Because I'm thinking, what's all going to be on those? What's all on those ships? Some of that stuff's going to go bad. So
Well, you have to imagine at some point they'll only let it go for so long before, the government will probably step in like they do. So we'll have to wait and see there.
Okay.
I don't want to say either way. I'm not as educated on what could happen there. I'm just more of a positive outlook person than a negative outlook.
Okay, so let's play. Let me play for you. Jerome Powell, chairman of the Federal Reserve. This is what he said about the recent cut rate. Okay.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
So, all right. I guess they're optimistic then, huh?
Yeah, that's what they say. But one of the things that does concern me is, while we have inflation trending down, it does concern me that with the economy still kind of pumping along like it is, that you're making these aggressive cuts. And one of the things that really tends to bother me is could that reignite inflation? And if that happens, then, we're going to see, rate increases again. But again, we just have to kind of wait and see. There's a lot of stuff going on right now with, I mentioned a few minutes ago with the bombing of Israel, the port strike on the East Coast, and then just, a little over a month out, we have an election. So there's just so much going on. We're just going to have to sit back and wait and see. But this is why it's important to have a financial plan in place, especially if you're a pre-retiree, maybe you're 5 to 7 years out. This is exactly why you build a plan. So you don't really have to worry about these types of things. Now, I get it. Some people say, well, this could be World War III and the end of the world and all of that. I'm not disagreeing with any of that, but I can tell you those who have built plans and have plans in place tend not to worry as much. And we've had these types of disruptions or conflicts or whatever you want to call them all throughout history. And everybody says, oh, well, this time it's different. Well, how is it different? It's different because it feels different to you, but it's happened for the last 40, 50, 60, 80 years. So, again, having that plan in place, I feel like is one of the mental safety nets, if you will, that just kind of helps you deal with certain things like this because you tend not to worry as much.
Okay. So what I want to do right now is talk about how these lower interest rates can impact retirees, because that's who we always talk about on our show.
Yeah, well, the last few years, we've benefited from, higher interest rates. So, for the first time in a long, long time, you could get a decent rate on a CD or a fixed annuity and really just yields in general. They were elevated. So the saver was making more return on their cash or their safer assets. But as these rates go down, obviously it's going to lower those rates, lower those yields. It's also going to impact if you're a federal employee with rates going downward, it's going to impact the G fund as well, because as rates rise, G fund rises. As rates fall, G funds will fall as well. But it will help bond funds out. So as rates go down, our yields fall, the value of the bonds will rise. So if you're a federal government employee, the F fund may tend to do a little bit better than the G fund during a decreasing interest rate type of environment. The reason this is important because usually when you're approaching retirement or if you're in retirement, you tend to, most people, not all people, tend to gravitate to more safer type assets. So with these rates coming down, it's just going to limit the upside ability for the retiree.
Right. Okay. So now let's talk about the benefits for consumers when those interest rates do start to come down.
Oh, man. Yeah. So I didn't pull the data before the show. I probably should have, so I could speak really intelligently about it. So I'll just speak somewhat intelligently about it. But I'm almost positive with over the last 2 or 3 months, as we've seen the 10-year yield fall, the 10-year yield and the 30-year mortgage rate, they kind of move in lockstep with a little bit of a spread between the two. And what we've likely seen, and I have seen some news on this, I just don't know how much, where the refinance rates or the refinance applications have actually gone up because interest rates have actually come down. It also helps things like credit card rates, new car loans, used car loans, things like that. So for the consumer, most people don't pay cash for a home. Most people don't pay cash for a car. I think it's around 80% of people actually finance a vehicle. So having those lower rates, those lower interest rates can actually help you get a little bit lower payment. And it should stimulate consumer spending. And here, this is why I've got a little bit of a concern, is consumer spending is still elevated today, even before the rate cuts. And so when you factor in more consumer spending, could that be inflationary? I don't know. We'll have to kind of wait and see there.
Mm-hmm. Right. So yeah, that'll be interesting. Now, how are you talking to your retirees right now about finding opportunities as these interest rates are starting to change, Chris?
Well, again, when we talk about rates falling, you have to start reviewing your fixed income side of the portfolio. You have to start looking at duration risk, within the portfolios to see if there's opportunity there. So when we're working with a family, we're, obviously taking into consideration, what the feds are doing with a monetary policy, because it tends to move certain asset classes in certain directions. So when we're having reviews, or I'm meeting with prospects, or we're talking with somebody that's considering becoming a client, we're having those conversations for sure.
So I want to give your phone number out. I want to make sure people have that handy because, today and every weekend we're offering a discovery visit, a way for you to reach Chris. Go in and talk to him about your situation. If you're concerned about interest rates and you want to make some changes maybe in where you have your money, Chris and his team can certainly help you do that. 256-937-2010 is the phone number. It's a way to reach out for this complimentary discovery visit. You can call or text the word visit 256-937-2010. All right, Chris, anything else you want to add to our topic of interest rates right now?
No, when I was talking about the refinance and, rates dropping, I was sitting there saying I didn't pull some data before before you came on air. But basically, yes, I just kind of did a quick search here, and it looks like mortgage applications rose to the highest level since July of 2022. That was 6 days ago, according to Housing Wire. So, people were probably, sitting on the fence. Should I buy? Should I refinance? And of course, when rates start to drop, people will typically move when rates actually move downward, obviously.
Right. I do wish, though, like in 2008, when it was cheaper to buy homes, it got cheaper to buy homes. I wish that would happen again, because now homes are just overpriced. when you buy a home, the interest rate will be less, but still right now it's incredibly hard to get into a house,
It's real hard, Luann. Actually, I'm glad you mentioned this. So I have Graham and Richard, who work with me, and they're both younger.
Yeah.
They're in their early and mid 20s, and both are really intelligent, both do a phenomenal job for our corporation. But when it comes to buying a home, it's a lot harder for them because they're younger and they're not yet in their peak earning years. So I agree with you. Like my kids, they're not going to be able to buy a home anytime in the very near future. They're going to have to make sure they save a lot of money. So that entry point is a lot harder for those individuals because of where the housing prices are. And then also, like, wages aren't keeping up with that at that same rate. So I think in order for the younger families to be able to get in, they're going to have to be able to have lower down payments. Prices on houses have to come down, or maybe they need to introduce a 40-year mortgage, which I'm really surprised that they haven't done that to bring payments down. Right? If housing prices stay elevated, can you do a 40 or 50-year mortgage? And please, for those listeners out there like wanting to throw rocks at me, I'm not advocating for it, but I am advocating for like our younger generation being able to afford a house.
Yeah.
Because everybody listening to the show has probably, bought a house at some point in time. There's probably a decent portion of the listener base that bought a house and it was kind of on the cusp of, wow, I don't know if we can really afford this, but at the end of the day, it did help their overall net because the house, the house increased in value. You paid it down and then you sold it and then moved that money probably to a new house purchase at some point in your life or paid it off. So, I think there's some things that they can do. And like I said, I'm really surprised that hadn't taken place yet.
Right. So the reality is that interest rates, like so many things in retirement, affect us. It's just another category, of, something that happens outside of our control. And Chris, this is what you do. We can't choose what's going to be happening when we retire, but we can be prepared for either scenario. And that's what you and your team do, help people maintain that current standard of living in retirement.
Mm-hmm. That is correct. I mean, interest rates are just one of the many things. You've got retirement income, healthcare, long-term care, taxes. I mean, you name it. There's just lots of things that happen in retirement that are outside of your control, and they're all kind of intertwined with each other. I like to say, especially when it comes to taxes, it literally touches everything within your retirement plan. So understanding how all of those pieces move and fit together as you turn the proverbial Rubik's Cube, as I like to call it, is really, really important.
All right. Take advantage of this offer from Chris. Make sure that you are positioned to make the most of these new interest rates that we're heading into as far as this environment goes. That number again to call is 256-937-2010. Call or text the word visit for that complimentary discovery session. We're so happy that you joined us today. You are listening to the Rocket City Retirement Show. I'm Lou Ann Fulmer with my friend Chris Wallace of WG Financial Group. All right, Chris. So now what we're going to do is get into talking about our 401ks. Because think about it. We've all, been putting money in those 401ks or, something to get us ready for retirement. In the past, retirees could depend on their pensions. We used to call that the three-legged stool: pensions, Social Security, and savings. But today, 401k plans are the more common part of all this. So tell us, what impact has this shift had on how individuals have had to plan for retirement?
Mm-hmm. Before we get into that, as you were kind of talking there, I want to go back and want to touch on something with interest rates.
Oh, okay.
So probably for the better part of 2024, we've been advocating for longer, when you're looking at fixed products, that you should look longer duration. And that's because we anticipated a rate cut, and we've kind of been saying it's been on the radar since the early part of 2024. When you're thinking about rates and knowing they're going to come down, and it is your risk tolerance or preference or however it fits in your retirement plan to have a fixed rate, you should probably look at longer duration. Now, I've been saying that, and one of the things that I think some individuals out there today listening to the show don't really understand is that the markets are ahead of that. So even though the Fed's just made a 50-point rate cut, the markets have been pricing that in for nearly 3 months. So a lot of the 10-year treasury yield started dropping in July. And so that was the market telling us, hey, there's a rate cut on the horizon. So these 50 basis point cuts are, most of the time, not most of the time, they are already priced in the market. So what does that mean? On some of your fixed products like CDs, they're not going to renew at the rates that you're seeing today. Those money market, those high yield savings accounts, they're all going to drop. So again, advocates for, we know rate cuts are coming. We know that's happening. The Feds have kind of laid that out for us. And if we're into that fixed rate stuff, which that could be money markets, high yield savings, that could be CDs, that could be annuities, all of those rates are going to start to drop. So again, you should consider longer duration type products. So with that said, let's take a look at 401ks. So would you mind repeating your question, Lou Ann, to me? I'm so sorry.
Well, yeah, it's okay. So, in the past, we always talked about for retirees, they had that three-legged stool, which were pensions, savings, and then, what was the other one? Social Security.
Social Security, right.
So today now, the 401k plans kind of come into that picture. So I wanted to talk about just what impact this whole shift has had on how individuals are planning for retirement.
Oh, for sure. Yeah. So the 401k now has become more in focus because the pension plans are becoming like dinosaurs, as we said on the show a number of times. So now it's really up to the retiree that's actually saving for their retirement to make sure that they're saving adequate amounts in their 401k. So there's increased responsibility on the individual. There's investment choices that, frankly, I would say most people don't understand.
Right.
There's aspects of the plans that they're in that they don't even understand. So I think the normal, and again, this is not meant to be offensive to anybody because I fell in this category when I worked in corporate America before I understood retirement planning and retirement plans. But there are people out there today, Lou Ann, who are they're working and they're working hard and they're saving. But sometimes there are plans that they're contributing to, and I'm talking about a 401k and maybe a 457B, where you have some additional things that you could potentially be doing inside of that plan, but your HR department doesn't know to tell you about that. So not understanding your current workplace retirement plan is it's a big oversight for many people today. In other words, there could be additional places to be parking money, but they just don't know that. The other thing that I've seen a lot of is target date funds. So target date funds, life cycle funds, they're called different names by different institutions.
Okay.
But they're fairly, I think they're really for the investor that doesn't know exactly what to do. So maybe you're new to the game and you're like, okay, I'm retiring in 2050. Okay, I'll pick the target date 2050 because that kind of matches with my time horizon. That's fine, especially if you're younger. That's completely fine. But if you're about 5 to 7 years out, this is where I think you can run into a little bit of trouble by not understanding what's actually in the fund. And what I mean by that is if you're in a target date, say 2025, of course, today's 2024, well, 2025 is just right around the corner. So if you're in that fund, you're probably thinking, well, it's got to be mostly bonds because those target date funds are designed and managed to become less risky as the year approaches. So right now, one would probably think, well, 2025, it's got to be mostly bonds. But if you open up and pull up or lift up the hood on most target date 2025 or life cycle 2025s, they're still going to have somewhere between 40 and 55% equity when you look at most of those funds. So that can overexpose a pre-retiree, especially someone getting ready to retire, to some additional risk that they're not aware that they're taking because they're just investing in the target date fund thinking, oh, it's pretty conservative because, 2025 is next year. The other thing is having to depend on that 401k. So we're talking about target date funds and the potential for loss. And, there's also the potential for gains. I don't want to, say that, there's not because there is, but if you're getting ready to retire and all of a sudden you're depending on your 401k, having it subject to some pretty wild swings in the market can really drive you emotionally crazy, but it also can hamper the longevity of your money. So when it comes to 401ks, one of the things that we do when we're sitting down with an individual or a family is we are asking about the 401k. So whether you're a government employee, local defense contractor, or work for one of the big name defense contractors, we ask about your retirement plan. And I've been in the game long enough now at this point. I have some gray hair, as we like to say, Luann. And I'm familiar with a lot of the retirement plans in Huntsville, not all of them, but there are certain ones that we see come through the office and we're able to tell an individual, say that you can do this in that retirement plan. So we need to have you, save some more money here. The other thing when it comes to 401ks, Luann, that I think is very, very, I don't want to call it confusing. Maybe it is confusing, but it's a decision point for a lot of people. And that is whether or not to put Roth I call it to Roth or not to Roth. So should I do Roth in my 401k? Should I do pre-taxed? Many individuals and families aren't sure what to do. So that's another big decision. And then this is the last thing I'm going to talk about on 401ks, with regards to this question is one of the things that I hear a lot. I won't say all the time, but I will say a lot. So I will ask the question when I'm meeting with someone. So what are you putting into your retirement plan? Are you maxing it out? Now, in my mind, I know in 2024, you can put up to $30,500 if you're 50 or older this year. That's what I know in my mind. Okay. I have people say to me, they say, well, Chris, I'm maxing it out. And I'll say, okay, how much are you putting in? Oh, $5,000.
What?
And then I say, wait a minute, you're not maxing it out. You're taking advantage of your match. Yeah. That's what I'm doing, Chris.
Gotcha.
I'm actually putting in 4% and they're matching 4%. So I'm maxing it out. No. You're not maxing out the retirement plan, and you have the means to do so, but you're only taking advantage of the match. Now that's a great thing. I'm not, not advocating for, listen, don't take advantage of the match. No, you should. That's free money in anybody that's not at least putting in enough to take care of the company match at whatever percentage, whether that's 2, 5, 6, 10%, whatever it is. If you're not doing enough there, that's a big, big oversight. And I don't want to call anybody out, but that's a big mistake in my book. Like, we have to take advantage of the free money and the company match.
Yeah.
So some people, as I mentioned, have the ability to actually to really max out that retirement plan with additional money. Now, let me give you an example. This is a situation that I see, or I have seen quite frequently. Okay. So we've got a family who, let's just say, is spending $6,000 a month in $6,000 a month in monthly expenses, but they have coming into their house, let's call it a net of $8,500. So after taxes, after putting a little bit in the 401k, they're netting $8,500 and they're spending $6,000. So they have a $2,500 a month surplus. They're taking that $2,500 a month surplus and they're putting it in their savings account. And in some cases, Luann, I have seen high 5 and 6-figure savings account. So we're adding another $30,000 of, taxable income into that savings account because we all know that the interest that's earned or paid on savings or CDs or high yield money markets, we pay ordinary income tax on that. So if you're generating, let's say, somewhere in the neighborhood of, $5,000 a year in interest income, and you're already in the 24 bracket, you're paying about $1,200 in federal taxes because of the interest that you're earning on the money that's going into that savings. And in this case, let's just say you have $100,000 or more in your savings account, and you're continuing to really exacerbate that problem by putting more and more money there, when in reality, you should be putting that in the Roth side of the 401k because you're not maxing it out. Because remember, when I started this long tangent, we were saying they were putting in a little bit into their 401k, and there's probably room there where they can put more into their 401k, and they can do one of two things. They could put it into the pre-tax and defer and actually save taxes today, or they could take that additional and put it into the Roth side of their 401k and not change their tax bracket because they're already netting money into their bank account. They're pushing over to savings. But if they would be utilizing the Roth side of the 401k in this situation, then they're moving money into a position where it's never taxed again. Because we know every year that we have money sitting in our savings account, the bank is going to send us a 1099 for the interest that they paid on the little bit of savings that we have in their savings institution. So sometimes when I'm working with a family, I'm looking to reroute how they're saving money. So think of it like this. We're wired to save money, which is good. As I've gotten older, you're the same way, Luann. We're wired to save money. We just want to save money. But sometimes when they come in, I will rewire how they save money and help them do it in a more tax efficient manner, both now and long term. And once I map this out on the board, I have an electronic whiteboard in the office that we utilize. There are times when I have drawn out on the board, I'll just draw kind of like a map and say, this is how I want you to start saving moving forward. So when they become a client, we tell them, okay, this is your savings map from here on out. So that's all part of our discovery session, Luann. We do a 3-meeting process. I won't get into that just now because we're up against the end of what we call the first segment here. So if you're listening to the show, this is the end of the first segment and you want to listen to the rest of it, you can hop out to Apple Podcast or Spotify and catch the full hour. If you're on the way to church this morning, that's when you're catching the 30-minute version. Our number, if you would like to call and set up a discovery session so we can review your retirement plan, so we can review your 401k and how you're saving money, that's 256-937-2010. Again, the number is 256-937-2010.
Don't panic in uncertain market times. Let Chris Wallace be your trusted guide. Call Chris Wallace today at 256-937-2010. That's 256-937-2010.
Chris Wallace and the team at WG Financial Group understand no matter how the 2024 presidential election shakes out, it's going to have a huge impact on your retirement. Now, more than ever, it's important that you have a clear understanding of what's at stake with your finances. Because as we've already seen, anything could happen. Major election surprises, like the ones we've been seeing, can potentially tip the balance on our economy. And on top of everything else, we also know our current tax rates are going to expire at the end of next year. And they'll go back up. Do you think your finances are ready for all of this? Chris Wallace's election stress test can help you find out. Schedule yours today with the WG Financial Group team by calling or texting ELECTION to 256-937-2010. That's ELECTION to 256-937-2010. See how strong your plan really is. Call or text ELECTION to 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor.
Want to feel confident in your financial future? Let Chris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Chris, let's talk a little bit more about those 401ks, but how the 401k plans really provide fewer investment choices. Some people just select options and then they just leave it at that. Talk about how setting it and forgetting it is probably not the best approach.
Yeah. So we're creeping up on Halloween. It's October, right? So, which speaking of today, actually the day we're recording this is Tuesday. It is my son's 22nd birthday, my twins.
Both of them. Yeah.
So happy birthday, big happy birthday to Caleb and Christian
Caleb
today.
and Christian, 22. Happy birthday, guys.
22, boy, what it would be like to be 22 again.
Yeah. Right. Oh.
So you mentioned that the 401k plans provide fewer investment choices. So I mentioned we're creeping up on Halloween. And when you were younger and you would go trick or treating, Luann, did you, because I hated this, I would get to the house. It would be like the last house in the cul-de-sac. And now all of a sudden you like, they bring the little bowl out there with the treats and candy in it. And there's like 10 of them in there. And they're like Smarties, right? I mean, they're terrible. Smarties are the worst Halloween candy.
You hated I liked Smarties when I was little. I don't like them now, but
man, Smarties at Halloween are terrible. And then when we get to Easter, is Peeps.
The Peeps. I
terrible
agree.
too.
I hate Peeps.
Yeah.
Agreed.
So anyway, you get to these, get to the last house or whatever. It's getting late and there's no candy left. There's just a very few selection.
Yeah.
That's kind of like how most 401k plans are.
Ah, gotcha. Very good analogy.
Very few funds to pick from. And what you're trying to do, just like you did when you go to that house and you're like looking in and in your mind, you're thinking, man, why didn't you buy enough candy? And so you're looking at your 401k selections and you're like, man, these are terrible. Like I don't have that many to choose from. There's 8. And let me look at the history. Let me look at the 5-year and the 10-year. And you're trying to look in the rearview mirror and pick your 401k funds. So they lack diversification. For one thing, and there's not enough of them. And sometimes you're missing certain things you should be taking advantage of in certain 401k plans. Sometimes, as I was mentioning earlier, you're exposed to inappropriate risk levels because you look at some people, this is not everybody, some people might look at the 10-year history on a fund and go, wow, look at that. It returns an average of 10% a year. So if I put my money in, that means I'm going to make 10% every single year, kind of like a CD in your mind. That's the way you're thinking about it. But that ain't the way it works in the market. But that's how the naive investor looks at it. It's like, hey, I'll just pick this because it averages 10%. So sometimes you can expose yourself to inappropriate risk. And then a lot of times when you're trying to manage your own 401k and you don't really know what you're doing, sometimes you don't even know how it aligns with your retirement time horizon. And I think that not everybody, but I think that some people listening to the show today should probably be thinking about adjustments as they get closer to retirement because maybe you're taking too much risk. Some people don't know. And I'll tell you, when it's going to slap you in the face is when we go through a big market downturn. And we just had one in 2022. So if you were in the market aggressively in 2022 and you lost, roughly 20% or whatever, and now you're that much closer to retirement, that can happen again. And the reason you lost that is because you're probably too aggressive and it probably, needs to, I guess, better align with your retirement timeline, but also your retirement plan if you have one of those. So I think there are people out there listening to the show that, we see the market go up and away. And if you think about like from a recessionary standpoint, if I'm really thinking about a recession, we haven't really had a recession since 2008. Now, I'm going to have people argue with me. Oh, we had a recession with COVID. It was coded a recession. Fine. It was. And it bounced back super quick.
Yeah.
So you forgot about it. And then 2022, that was painful because we had both stocks and bonds go down at the same time, and they went down for the vast majority of the year. So it was kind of like death by a thousand cuts. But 2022 was a really good year. So it came roaring right back. So we've really, I think, almost forgotten what a real recession looks and feels like. And I'm not advocating for pushing all your money out of the market or going to cash or not anything like that. That's not who we are. But we are advocates of building a plan so that your investments are structured in a fashion that it supports your long-term objectives and goals, but also that mental, emotional side of it as well, because there's a lot of psychology with money. And I think people have to take that into consideration, as they build out a retirement plan.
Right. So in this case, would it be better then to change from, 401k to investing into or turning it into an IRA? Because there's more investment choices there, right?
Well, so that's a great question. You can do most plans allow you, and I'm only aware of one in the Huntsville area that won't allow you, and it's a banking institution. I won't say the name on the air, but they will not allow an age 59 and a half rollover. So when the 2008 crash happened, there was some rules and laws changed to where you can now, most companies, most 401k plans, and it's really up to your plan. It's up to your plan document to allow what's called an in-service rollover out to an IRA. So we do have some people that will do that for the appropriate situation. So one of it could be lack of investment choices. The other one could be maybe there's some internal fees, because a lot of times what we see in 401ks are all mutual funds, which usually, not always, will carry a higher expense ratio. But now we are seeing some index funds and some mutual funds. But the reality is most people that are trying to invest in these funds don't understand which ones to pick. So investment choices, fees, and then there could just be other reasons why you may want to roll it out. Maybe it's just to have the money managed and looked after by someone other than the 401k plan and yourself trying to manage it. So there's a number of reasons why it could make sense. And then there's some that don't make sense. So right. I think you have to take it case by case.
Okay. So, how then should someone's age influence their selection of their investment options? Talk about that, why that's important to maybe tailor choices over time.
Yeah. So I'm not a big fan of the age factor. Okay. So I do have friends in the industry who use age as like one of the indicators of how much stock exposure you should have. I'm more of a plan guy. So let's build the plan first and let the plan kind of tell us where we should or shouldn't be based on what we're going to spend early in retirement. What if we see a recession in the first 1 to 2 years of our retirement? How does that impact the plan? I start with the data first. And then once we have the data, then we can start talking a little bit to that emotional side of things. So Lou Ann, we've talked about on the show before, I believe listeners have what's called, investors have what's called risk capacity and risk tolerance. And they're two different things. Your capacity for risk would be like your financial plan. Your plan may say you could be 100% stock and you're totally fine. Even if we have a recession and with the money you're withdrawing, everything's good. That's risk capacity. The risk tolerance is more of how much can you tolerate? How much can your stomach, how much can your mind actually tolerate? And I think the magic with a financial advisor happens where you can work with a family on really trying to marry those two together as best as possible, because there are some listeners out there today, Lou Ann, who've actually won the retirement race, and they may have, the plan may have a greater capacity for risk. So let's just say I've got $5 million saved for retirement. I have plenty of money. I'm not going to run out. Plan says I'm good, but I can't deal with the stresses of the ups and downs of the market. So they've won the race. They don't want to run anymore. So at this point, maybe their risk tolerance is overriding the risk capacity. And so they may, in this case, this individual, I'm kind of describing hypothetically here, may want to back down on the risk because that will allow him or her or their family to really just live retirement without worrying. They have enough money And because one of the things we have to ask ourselves is, when is enough enough? You know?
Yeah.
And that's, you know, that goes for a lot in life, Lou. And that goes for me at the dinner table. Like, when is enough enough?
Yeah.
And I'm gonna tell you, throw some Sonic cheese sticks in front of me or some cheesy something. I don't know when enough is enough.
It's
I'm like
hard.
the dog that will just eat himself sick or bread. You know, you go to some of these restaurants and, man, come on.
Dang.
Don't get me started. I'm hungry now. So
I know.
you know, you have to ask yourself when it comes to, you know, your retirement savings is, you know, when is enough enough? And you know, you have enough if you run your mathematical models and you're honest with yourself about your spending. You know, do you have enough? And then, you know, kind of saying, well, enough is enough. And I don't want to worry. And everybody's different, right? They are. But I have some multimillionaire clients who just don't want to deal with the major ups and downs, and they're ready to just kind of relax in retirement. And frankly, Luann, that's how I want to be.
Yeah.
That's exactly how I want to be. I don't want to be checking my account every day. I want to have some strong income streams, and I don't want to worry about the market volatility, and I want to travel as much as my wife wants to travel, because, you know, I'm not a big I don't like to travel.
Yeah.
So I'm going to be drug around kicking and screaming. But I'm going to go, you know, because that's what I'm going to do.
Yeah.
But I don't want to worry about these things. So anyway, that's kind of my thoughts there.
So obviously then, you know, we all are depending on our 401ks now, kind of the cornerstone of our retirements now. But we do need to avoid costly mistakes. And one thing that you do and that you are offering is for our listeners to call in, and you could do some type of a, you know, personalized, we call it the discovery session, but you would review people's plan, right? And help them figure out, you know, are they doing the right things? That's what you do every day throughout the week. Let's talk about what that discovery visit is like.
Yeah. So for the discovery visit, it's a pretty simple meeting where, you know, a family, an individual or a family, they're going to come in, and we're going to sit down and we are going to just have a conversation about their situation. The meeting lasts about an hour and 15 minutes. So sometimes it goes an hour and 30. It really just depends on the questions. We do encourage questions. We want people to ask questions. During that discovery session, we're going to uncover a lot. I say we, as in the company, because we're going to ask a lot of questions, probably more than you've ever been asked before. And we're going to ask some questions nobody's ever asked you before, because our planning philosophy is more on the holistic spectrum. So we're looking at retirement income, which consists of Social Security, pensions, pension strategies. Which pension should I take? Should I take the lump sum? We're going to take a look at Social Security planning. You know, if your wife is older than you, which is not the normal case that we see, maybe she's 2 or 3 or 4 years older and she's the lower income earner. Now we have to look at when's the best time for you to actually claim, because maybe she gets a little bit more spousal and you have to have claimed in order for her to get that. So we're looking at all of that, kind of the tax efficiency of your retirement plan, the investments, the fees, the risk that's associated, what happens if there's a recession early in retirement. A lot of people, Luann, don't even know how they're going to take income out of their retirement plan. When it comes to estate planning, we're going to ask questions. We're not attorneys and I don't give legal advice, but I'm going to ask, do you have your documents in place? And then there's a few other estate questions that I'll kind of ask, and we'll direct you out to an estate planning attorney. Should I see the need that I think you need that, then I'll send you out for that. So, the discovery session is that we do, like I said earlier, we kind of do a 3-meeting process. So we do that in-depth discovery session. And then we do what's called a high-level strategy session, in meeting 2. And if we need to go to a 3rd meeting, we'll do that. But I discuss all of that in this discovery session at length. But the discovery session for most people is a good opportunity for you to come in, get an honest appraisal of your situation, honest evaluation of your situation, and for you to interview us. That's what we say. We're interviewing you as well. I mean, people think when they come in, oh yeah, I'm just here, Chris. I'm shopping, I'm searching, I'm interviewing people. I'm like, great. I interview about 6 every week, and you're number 6. So yeah, I don't say it that way, but I'm interviewing too, right? Because we have to make sure as a company, we want to make sure that we're the right fit for that individual or family that's coming in to see us, just like they want to make sure we're the right fit. It is a two-way street. Sure. So we encourage a lot of questions, but it's a fun meeting. I met a guy, earlier this week in the automotive industry. And we're probably a few years apart in terms of where I was at, where he was at, but I've been in some of the same assembly plants that he's been in.
Oh, wow.
I've lived in some of the same towns that he worked in.
Crazy.
And yeah, it was wild. And I got chills actually just now telling you about it, but it was just kind of cool to have that overlap. And I tell people, hey, listen, I've got gray hair. I'm 51. I've got some history in corporate America behind me in the auto industry and manufacturing. We're probably going to have a lot in common. So I use my little discovery sheet to keep me on track, because while I want to connect with you, there's still some information that we want to get to make sure that we serve you correctly. But it's fun. Like I said, the meetings are fun for me. I love to do them.
All right. So we are offering a chance for you to get some advice about retirement planning. Anything that we're talking about today, if you have questions, Chris will provide you with answers. They will, take into consideration everything that you tell them, and they'll put a plan together for you. So reach out for this complimentary discovery visit. Get another opinion, get a second opinion on your retirement plan. If you haven't done that yet, call or text the word visit 256-937-2010. That is the way to reach Chris. Get on his calendar, complimentary, 256-937-2010. You can call. You can also text the word visit. And we thank you so much for joining us. You've tuned in to the Rocket City Retirement Show with my friend Chris Wallace of WG Financial Group. We're talking about 401ks today and how it's so important to make sure that we preserve our assets that are in the accounts and optimize them. So, Chris, you've been sharing some great information about 401ks. What else do you want to say as we wrap up our show today?
Yeah, so we've got, about 10 minutes left in the show. So I've got some really good information. So I would say if you're, driving, obviously, don't take your hands off the wheel or anything. But if you're sitting in a parking lot, maybe you're getting ready to go into Lowe's or Home Depot or wherever to do your Saturday morning chores or errands, then I want you to just sit tight for a second and listen to this. And if you have to, I guess, leave the show, and you can always go to Apple Podcasts and Spotify and pick it up on the way at a different time. So what I want to talk about is the catch-up contribution. So right now, we know today in 2024, in the year that you turn 50, you can put in an additional amount into the 401k. So that would be $7,500 under today's law in 2024. That is in the year that you turn 50. So you don't have to wait until you're 50. It's in the year that you turn 50. So the IRS looks at your birthday as December 31. So that's the way the law is today. But there's going to be a lot of people out there listening to the show today, Luann, that they're just not aware that what is happening in 2025. So in 2025, if you turn 60, in the year that you turn 60, and this goes from 60 to 63, you can put in an additional $10,000 or 150% of the age 50 catch-up. So you can't put in 75 plus 10,000. You can put in up to 10,000 or 150% of what would be today's catch-up of $7,500, which would make, if it were today, it would make it $11,250 is what you can put into the 401k. So you can put in, let's call it, around $5,000 more between age 60 and 63. So again, it's 10,000 or 150 of the catch-up contribution today. If it were today, it would be $11,250. Now that starts in 2025. So we're talking about Roth IRA money, and Roth generates taxes today. Some people put in pre-tax. Well, in 2026, this is just a reminder. We've talked about this several times on the show. And again, I'll toot my own horn for the show here. We like to give away a lot of good information, stuff that you're not going to hear unless you're reading online. You're usually not going to hear this stuff on a radio show here in Huntsville. In 2026, if you're making more than $145,000 in W-2 income, then the catch-up contribution must go in as Roth. So take a look at the increased amounts. Okay, so let's just take, for example, somebody's able to put in $11,250. You have to assume if someone can save that much money, then they're probably making more than $145,000. So when we're talking about Roth IRAs, Roth 401ks, and I've heard people say, the Roth is going to go away. No, it's not, because it helps the government generate tax today. So in this case, we're talking about this extra catch-up contribution in, starting in 2025. In 2026, that extra catch-up would actually have to go in as Roth. That generates tax dollars today for the government. So that's really targeting high-income earners. Now, that's not necessarily a bad thing, because now you've got some Roth money building in the 401k. So I think that's important to everyone's financial plan. But here's one of the other points that I want to make. 2025, if you are able to put in that extra amount that we're talking about, the $145,000 income limit doesn't start until 2026. Mm-hmm. So if you're one of these that defers money, maybe you're a high income earner making, I don't know, $300,000. Maybe you and your wife together, or you and your spouse together make maybe $350,000, and you're trying to defer. Well, in 2025, you're going to have the opportunity to defer a little bit more, because that extra catch-up amount goes into effect from age 60 to 63. So if you fall in that bracket, that's a prime opportunity to go ahead and actually defer a little bit more money. But in 2026, again, you're going to have to put that in as catch-up into the Roth. And so I think as you're thinking about your tax picture and kind of what you're trying to, accomplish with your goals and objectives, I think you have to know some of the rules. And I wanted to make that known today, because I feel like that's an area where people can take advantage in certain situations. I've run into people before, and we may have talked about it in a previous segment on one of the shows, but I often hear people say that they're maxing their 401k, and they're not maxing. They're maxing to get the match, but they're not maxing. This right here would allow you to really, really ramp up that savings. So again, just wanted to bring that to the air, Luann. And we were talking about the discovery session and kind of what our meetings look like. I mean, these are the type things that we're talking about. And I think for our radio show that we do, we take a lot of pride in really disseminating a lot of good information across the airwaves, a lot of information that can be used, really taken and applied, in some cases based on your specific situation. Obviously, I can't give like financial advice over the air, but you may find some of these nuggets by listening to the show that will really better prepare you as you're preparing for your journey on retirement. And I'll tell you, Luann, when we have people come in, a lot of times they've come in well prepared, because I would say that the large majority of our listeners have been listening for a long, long time. And in some cases, 6, 7, 8 years, because right now we have the longest running independent radio show in Huntsville. And we're very proud of that. Well, when some of those longtime listeners come in, they come in and they've got all their documents in order. They're saving in a lot of the right areas, because we talk about order of operations and ways in which to save money on, in your accounts as you're prepping for retirement. So those listeners come in a lot more prepared, because they've listened and they've taken those little nuggets of information, and they can go fact check and, double check it on Google, because that's what everybody does. Every time you go to the doctor and you're prescribed a medication, the first thing you do when you get in the car is you sit there before you pull out the parking place, and you're like Googling the drug that they prescribed you and looking at all the side effects. And I'm sure people do that when we talk about financial stuff on the air, Luann. But I think this is a great a great piece of information for people to take into consideration as they start planning for 2025. Because as it's already October.
Yes. It is.
It's not going to be long.
No, but great information there. And I love how you said, you can only give, nuggets on air, but you can go and dive into it more in a personalized meeting, in that discovery visit.
Right. Those meetings, Luann, we uncover so much stuff in the meetings. And I've literally had people sit there and they'll tell me at the end of the meeting, they're like, wow, I've never been asked some of these questions before. And some of them are kind of intrusive a little bit. I ask some pretty pointed questions, because that lets me know if there are particular things that we can do to help or they can do to help themselves. And I had someone come in the office last week, and it was pretty funny. When I started the meeting, I always have somebody in the meeting with me taking notes, and I basically said, hey, you're going to get an email at the end of this meeting, and it'll have some things in there that you can probably do today to help your situation. And then there's probably going to be some homework that we're going to need, from you. But there'll be a couple things you can probably take and do yourself. And so at the end of the meeting, it was pretty funny. The gentleman kind of stood up and he's like, wow, I didn't even know I was going to come in. I didn't know I was going to come in here and actually take a couple of things away that I can actually do. And I just looked at him and I said, I think about an hour ago, I think I told you that. And his wife started laughing because there are a few questions that we ask that I would say the vast majority of people that come to the office, they're just not doing. And it's real basic stuff. It's stuff I don't get paid on. But when I'm sitting down with a family, I don't always have to get paid. Part of my job as a certified financial planner and financial advisor is to really look at someone's situation in depth and really steer them in the right direction, whether that be legal. Maybe they need some estate documents. Well, obviously I don't do that. So I'm going to send you a referral for that. Or, I may ask some tax related questions. And obviously I'm not a CPA. So, maybe I steer them towards another CPA or something to kind of take a look if something doesn't look exactly right for me. We just have people come through the office and I run them through those sets of questions, and it's inevitable. Most people actually aren't doing them. So I think that's where the big value comes, Luann, is just sometimes people are coming in and they're just looking, they're interviewing. And like I said, in an earlier segment that we're interviewing too. And it's important that when we sit down with a family, we want to be the right fit for them. We really do. And if we're not, that's okay too. We can still wave at each other in the grocery store and, say we're friends or whatever. I don't hold any grudges. I'd love to tell you that everybody that comes in the office becomes a client, but they don't. And sometimes that's our choice and sometimes that's their choice. And at the end of the day, we just want to be a good fit for families and individuals that we work with. So Luann, it's been a really good show.
Yeah.
Just really,
I think so.
Yeah, lots of information here. So
Thank you, Chris. Thank you so much for enlightening us.
You are welcome. So we look forward to getting calls this weekend. I'm sure people are going to have some questions on all of this stuff. And if you want to do that, you can reach us at 256-937-2010. Again, the number is 256-937-2010. I hope everybody has an awesome and blessed weekend. And remember to serve every person in every situation with a servant heart.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisor requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.